Hey everyone, and welcome back to the channel. Today we're going to talk about how does the stock market work for beginners. Let's get right into it. If the prospect of investing in the stock market makes you nervous, you're not alone. Individuals with little financial experience are either terrified by horror stories about average investors losing 50% of their portfolio value, or duped by hot tips that promise huge rewards but rarely deliver. It's no surprise then that the investment sentiment pendulum is said to swing between fear and greed. The truth is that investing in the stock market is risky, but when done correctly, it is one of the most efficient ways to increase one's net worth. While the average person keeps the majority of their net worth in their home, the wealthy and extremely wealthy typically invest the majority of their wealth in stocks. To understand the mechanics of the stock market, let's start with a definition of a stock and its different types. A stock is a financial instrument that represents ownership in a company or corporation and a proportionate claim on the company's assets and earnings. Stocks are also referred to as shares or equity. There are two types of stock: common stock and preferred stock. The term equities refers to common shares, which have a much higher value and trading volume than preferred shares. The main distinction between the two is that common shares typically include voting rights that allow the common shareholder to participate in corporate meetings and elections, whereas preferred shares do not. Preferred shares are so named because preferred shareholders receive dividends and assets before common shareholders in the event of a liquidation. The voting rights of common stock can be further classified. While the basic premise of common stock is that each share has one vote, some companies have dual or multiple classes of stock, with different voting rights attached to each class. In a dual class structure, Class A shares may have up to 10 votes per share, while Class B shares may have only 1 vote per share. Dual or multiple class share structures are intended to give a company's founders control over its fortunes, strategic direction, and ability to innovate. Many of today's corporate behemoths began as small private entities founded a few decades ago by a visionary founder. Consider Jack Ma, who founded Alibaba in 1999 from his apartment in Hangzhou, China, or Mark Zuckerberg, who founded the first version of Facebook in 2004 from his Harvard University dorm room. Within a few decades, technology behemoths like these have risen to the ranks of the world's most powerful corporations. However, growing at such a breakneck pace necessitates access to vast amounts of capital. To go from an idea in an entrepreneur's head to an operating company, they must, among other things, lease an office or factory, hire employees, purchase equipment and raw materials, and establish a sales and distribution network. Depending on the size and scope of the business, these resources necessitate significant capital. A startup can obtain such funds by selling shares or borrowing money. Debt financing can be difficult for a startup because it may have few assets to pledge as collateral for a loan, particularly in sectors such as technology or biotechnology, where a firm may have few tangible assets. Plus, the interest on the loan would impose a financial burden in the early days when the company may have no revenues or earnings. As a result, equity financing is the preferred option for the majority of startups in need of capital. To get the business off the ground, the entrepreneur may use personal savings as well as friends and family. As the company grows and its capital requirements increase, the entrepreneur may turn to angel investors and venture capital firms. When a company is established, it may require access to much higher amounts of capital than can be obtained through ongoing operations or a traditional bank loan. It can do so by selling stock to the general public in an initial public offering. This changes the company's status from a private firm with a few shareholders to a publicly traded company with many members of the general public holding shares. The initial public offering also allows early investors in the company to cash out a portion of their stake, often with very large rewards. Now, numerous studies have shown that, over long periods of time, stocks outperform every other asset class in terms of investment returns. Capital gains and dividends generate stock returns. A capital gain occurs when you sell a stock for a higher price than you paid for it. A dividend is a portion of a company's profit that is distributed to its shareholders. Dividends play an important role in stock returns. Since 1956, they have contributed nearly 1/3 of total equity return, while capital gains have contributed the other 2/3. While the allure of buying a stock, similar to one of the fabled FAANG quintet, Meta, Apple, Amazon, Netflix, and Google parent Alphabet, at a very early stage, is one of the more tantalizing prospects of stock investing, in reality, such home runs are few and far between. Investors who want to hit for the fences with their portfolio stocks should have a higher risk tolerance. These investors will prefer to make the majority of their money from capital gains rather than dividends. Investors who are conservative and require income from their portfolios, on the other hand, may choose stocks with a long history of paying substantial dividends. That's it for today. If you guys enjoyed the video, make sure to hit that like button. Don't forget to subscribe and turn on that notification bell so you never miss out on any future content we'll produce for you guys. We're signing off now, but we'll be sure to catch you all in the next one.